Hey there, I am Armin Chandra at Exun, and I welcome you to the Exun Talks. Exun Talks are a series of Exun Talks are a series of interactive webinars and talks during the Exun week. These are conducted by professionals across a truly dizzying array of topics and of different types, from game development to the future in automation. With constant interaction, it is a fantastic experience for everyone involved. To know the date and timings for the upcoming Exun Talks, please check out exun.co/talks. Today with us, we have Prateek Swain. Prateek is founder of Swadesh, a Y Combinator and venture-backed fintech company, and an alumnus of Princeton University, batch of 2019, and Exun batch of 2015. Without further ado, here's Prateek.
Thanks so much, Ariman. Hey everyone, this is Prateek here. It's absolutely wonderful to be back to Exun after such a long time, and not as a member, but as an alum, and giving a speech or a talk on the topic today. So I was brainstorming for a while and trying to figure out what could be interesting to talk about. Chances are, if you're looking at this speaker session, you are probably pretty smart already. Are curious, have been participating in events, or at least have come so far. So what could I share with you that could be interesting to you? And I figured, why not talk about how to design your own bank? Because banks are cool, they're big, they're ubiquitous, and why don't we break it down, understand how banks work, what's the history behind them, how do they make money, and maybe that can give us a couple of hints and clues about the future. So that's basically what the talk is about today. And as we progress, I'll tell you more about how we're going to do this and what's going to happen. So just stick with me. So Ariman did a stellar job of giving an intro about me, but to basically summarize, I started my technology journey in 2013, almost a decade ago when I joined Exun. And since then, that sort of shaped me who I was and got me very interested in technology and startups and entrepreneurship in general. After school, I ended up at Princeton, where I studied computer science and politics. In my free time, I basically ended up building the entrepreneurship ecosystem at Princeton. One of my favorite projects was setting up Princeton's first accelerator program from scratch called Make Ventures Princeton, which is still live in its fourth iteration. And my other hobby or passion was sort of international relations. And so after graduation, I decided to combine both of these things and ended up starting my own company, which had also been a childhood dream of mine since my Exun days. Once an Exun senior told me what YC was. And so Swadesh came into existence, which is sort of the intersection of, cross-border fintech, which is basically international relations and startups. So enough about me. Let's jump into the topic today. So before we go into this, I wanted to touch upon why you should listen to this or why would this be interesting to you. First and foremost is because we're talking about banks and fintech in general. And if you ever want to work in technology, you will realize that every tech company, or in fact, every non-tech company even, has a fintech component to it. There's a famous saying that goes on in the Valley that every company eventually becomes a fintech company. So if you understand the building blocks around how banks work, how these financial systems work, I think this could set you up really well in the future if you're interested to pursue fintech. And even if not fintech, if you're interested in just either building startups or working at a tech company. If this doesn't excite you, I also have a special Easter egg at the end of this presentation. So as things go, we'll towards the end of it, we'll talk about what the Easter egg is. Right. So let's talk about banks, right? Like, I mean, when you think about a bank, chances are that an image like this would pop into your head, something like a ATM branch at the corner of your society with a guard standing by. Or maybe a branch with a lot of people, tellers, counters, and just like a physical space where you have to go to submit checks or create accounts or things like that. Or maybe one of those annoying ads that you get on the internet or TV telling you about X% off through this credit card or that credit card. And to understand, how we got here and what the future of this looks like, we first must go to the past. So before we go to the past, let's define what a bank is. According to the Merriam-Webster dictionary, A bank is an establishment for the custody, loan, exchange, or issue of money, for the extension of credit, and for facilitating the transmission of funds. This is basically a fancy way of uh, saying things, right? If you think about it, custody and issue of money are around the same thing. Loan, extension of credit are the same thing, and transmission of funds and exchange are the same thing. So if you were to boil it down into its building blocks, its essential elements of what a bank is, I have this formula for you, which is a bank is effectively debit plus credit. Debit being you debiting your funds as a customer at an institution, and credit being another customer requiring that surplus of funds. And of course, this is all wrapped around an exchange of money, which is the third aspect. And that's all wrapped around a layer of trust. So now that we have defined what a bank is, we understand, these are the basic building blocks. Let's go back in time and see how this came into being. So when we look at the origins of banking, so banking has existed longer than banks have existed, since almost the inception of time, when inception of society, when we've had exchange of grain, the barter system, and everything else. There has been this concept of credit, right? But when you look at humanity as a whole, and you look at the economy of the humanity, for example, right? Like you look at our overall value creation up until the 1500s, the entire economy of the world was about a couple of $100 billion. And there was very little increase in this based on increase in population and other factors, but nothing exponential. However, in the last 500 years, just 500 years, that same economy of a couple of hundreds of billions of dollars has gone up to $60 trillion, which has effectively been an explosion of human value. And that's largely been driven by finance and largely been driven by credit. And part of the reason has been because credit is what happens when credit is effectively believing in the future, right? And until the scientific revolution came around, most people didn't think that the future was going to be better than the past or the present. But when the scientific revolution came around, people started thinking, hey, you know what? Maybe the future is going to be better than the present right now. So maybe there is a possibility that if we were to extend credit, we could get better returns in the future. And this had a very strong impact on society as a whole for a lot of reasons, right? So let's take an example. Let's say in the 1500s or 1400s, you're sort of a person, you're like a farmer in a town, and you realize that you have a talent for baking. So this is an example, I've taken from someone else who's put it really well. But let's say you're a baker, and you have this idea that you should open a bakery and start selling cupcakes. Now, to open a bakery, you need capital to set up the store, and you don't have that, right? And to get the capital to set up the store, you need to sell cupcakes so that you can afford the cost that is required to set up the store. But back in 1400, no one believes this will succeed, so no one is willing to give you this capital because that concept of credit is not prevalent. And so you're never able to, open the store, never able to pay back your contractor, never able to sell those bakery products, and never able to make extra income and then transfer generational wealth and basically do all these hundreds of other things. So this is a very small example of basically what credit has allowed us to unleash. Because then in this example, a bank comes along and gives you credit, right? And so you're actually able to go open a bakery, start selling bakery products, repay your loan, pay the contractors who help you set it up, pay your employees and so on and so forth, and just go through the whole motions of setting up a company. And maybe 50 years later, you IPO and then are sitting in Mexico in a beach somewhere chilling. But that probably doesn't happen in the 1400s. But you get the concept, right? That this whole idea of banking from the 1500s and has really unlocked human value. And an integral part of that has been banks, which have been the source of offering credit to individuals like us by accepting our debited funds. So you would be wondering why I'm talking about all of this, but this is just to give you an idea about the sort of lens in which banking has come along. Back in the day, lending was not something that was considered very interesting or appealing. Today, if you look around, most of the fintech companies, most banks and everyone is practically throwing loans at you, right? Like half the advertisements, TV ads, etc., is about some investment product or some lending product. But it doesn't take a lot of effort to realize that this is a very recent paradigm shift that we have had as society. And the best example of that would be Shakespeare. If you think about Merchant of Venice, the story is effectively about a, a creditor who gives a loan and the person defaults on that loan. And then the creditor takes the defaulter to court and actually loses the case. And we all cheer on the defaulter. So this sort of shows you the sort of mindset the society had against creditors uh, up until very recently. So this is the kind of like change due to the scientific revolution and due to the existence of banks that has really unlocked a lot of human value. Now that we have sort of understood the origins, let's actually answer the question, why do banks exist? And they exist for three primary purposes. First is that they're a store of value. So this is essentially the debit part of the equation. Second is that they, as we mentioned, they're a source of funds. So they offer capital to unlock human value. And finally, they're able to do both of these things because they act as an agent of trust. Usually, most banks have a central regulator in the state or country that they operate in, which is able to scrutinize, oversee, and take action against them. So basically is in charge of them. So for example, in India, it's the Reserve Bank of India. In the US, it's the US Fed, and so on and so forth. On top of that, today, banks are public entities mostly. And so not only do they have open financials, they're also publicly accountable to shareholders, which gives this added layer of trust. And so this just acts in enabling us as customers have trust in this third party about the safety of our funds and as well as the guarantee of funds in terms of credit. So how do banks make money, right? Like what allows a bank to make money? To answer this question, let's look at a bank's website, for example, HDFC. Now, apart from the hideous UI that you see over here, you will see a lot of options over here, right? There's home, pay, save, invest, borrow, insure, and a lot of things that practically overwhelm you. And you must be thinking, wow, they must have really complex business models, and there must be some sort of math wizardry and financial engineering going on behind the scenes for them to make money, right? Because they have hundreds of products. How do they reconcile them? They have so many different verticals. What happens? And that is partly the answer. Yes, they do have a lot of financial engineering going in the back end. But if we were again to break this entire piece down into its most fundamental layer, we would see that in short, banks make money through one and only one channel, which is lending. Now, the slightly shorter, slightly longer answer is that they make money through a couple of ways. First is the exchange of funds. So transfers from one bank to another that offers banks certain revenue. Interchange. Interchange is one of the primary drivers. So for example, if you have a debit card or a credit card and you swipe at any restaurant online or somewhere else, your bank earns a commission because of the card being accepted or the card being used over there. So the merchant bank, which is, let's say in this case, you are at a restaurant, the restaurant has a credit card machine. There's a lot of complex pieces that go on, but essentially it's a merchant bank, which pays for the facility to your bank for this transaction to happen. And usually this is about 1 to 2%, which doesn't sound like much, but in terms of a bank's profit margins is a huge driver of revenue. And finally, there's spread. So spread is effectively, spread is the difference between what the bank pays you as interest and the rate at which the bank lends. So these are the three ways that a bank makes money. Now, before we move on, let's try to understand how do we effectively so now that we know like what a bank is and how a bank makes money, the next question is, how do we judge whether a bank is able to make money effectively or not? And to answer that question, first let's define this term KPI. So also tangent, but a KPI is something you'll probably learn very soon as you end up working at a technology company at some point of your career, because a KPI is effectively a North Star. It stands for a key performance indicator, and it's effectively a scale to measure your success as a business. So the reason we're defining the KPI over here is we should have a goal that the bank goes towards to understand how healthy its business is. How do you measure profitability? What is the goal you're eventually leading towards? Before we go into that, let's just talk about what a KPI can be. So, for example, the KPI for WhatsApp could be the total number of messages sent because that shows the growth of the business. And the KPI for Ola may be the total number of rides completed because that again shows the growth of business. Similarly, the KPI for a bank is a term called net interest margin, what or NIM for short. So this is a term thrown around by bankers a lot, and it's one of those typical scenarios where they'll throw these fancy, complex terms to have their own inside club and make you feel like you don't understand what's happening. But really, NIM is the most simple concept that ever exists. Effectively, the NIM is the difference between the cost of funds and the interest that's charged. So basically, if you're a bank, you have to pay interest to your customers who are depositing money with you. And then you have some expenses. You add both of them, and then you subtract that from the interest that you're making by giving out the money as a loan, whether it's a home loan or an infrastructure loan or an education loan. And you get what's called a NIM, and that's your KPI. So let's take a second and figure out what all we have covered so far, right? So we have covered the origin of banking, why banks exist, how they make money, and what the KPI is. And these are four things I think are super useful for you to know so that you can learn how to design your own bank. So now that we've set up all these building blocks, let's go to the next step, which is contextualizing all of this in India. So first question is, how do banks make money in India, right? So to answer this question, we can again go back to a previous slide that we just discussed. There is interchange, which is effectively the transaction revenue that a bank earns every time a customer swipes the card. There's transfer, so there's bank-to-bank transfer. Let's say there's a wire transfer from you to your friend's bank account, or there's an international FX transfer from, let's say, your parents' account to you if you're abroad. So these are, the exchange of funds is one big lever, and then of course spread as we discussed it. So sounds simple, right? Sounds pretty straightforward. But there's one challenge, which is because of the unique situation that exists in India, banks practically can't make money out of these. First and foremost is that interchange in India is capped at 15 rupees. What that effectively means is, regardless of the transaction amount, the bank's revenue is not scaling as a percentage of the transaction revenue, but is capped at 15, or now recently with an amendment, 20 rupees. So I'll tell you why this is a huge hindrance. Because let's say that you were to buy a smartphone using your debit card. Let's say the smartphone costs 10,000 rupees. If you were in the US at an average, let's say, NIM of 2%, or interchange of 2%, you would have made 2,000 rupees. Oh, sorry, 200 rupees out of that transaction. But now, because of the RBI regulation, you can only make 15 rupees, which is less than 1/10 of the revenue you could earn. And so this is drastically affecting the bottom line of Indian banks. Second, transfers. Transfers used to be a great revenue stream for banks, which practically vanished overnight when UPI was introduced. So UPI is amazing for you, me, and everyone else, but for banks, it's bad business because that's a huge revenue line that's just completely been cut off. And the final part that we're left with is spread, where banks are constantly realizing that they have very high capex and opex and very limited amount of insights into who their customers are. And this is causing this vicious cycle of them also trying to survive as opposed to succeed. So to define OPEX and CAPEX, again, fancy terms, but they stand for something very simple. OPEX is operational cost, CAPEX is capital expenditure. So operational expenditure, capital expenditure. So they basically refer to the cost of business. And the other challenge that the banks are facing is that the reason that the spread is reducing drastically is because of a lot of bad loans that they've given out. So if you look at the current state of affairs in India, unless you've not been keeping up with current affairs, you've probably heard about all the negative news surrounding banks in India, right? Like recently, PMC Bank, which is the Punjab and Maharashtra Cooperative Bank, went under. Before that, Yes Bank went under, and before that, there were all these newspaper articles about bad debt in BFSI, etc., etc. So BFSI stands for Banking and Financial Services Industry, and it refers collectively to the whole, finance industry. And basically, what's happened is because of humans in the loop and human errors, we've had a number of top bankers give uh, extraordinarily large amount of loans to concentrated clients. So, in the case of PMC Bank, for example, a majority of their loan book was basically lent out to this one entity called HDIL, the Housing Development and Infrastructure uh, Fund Limited, or I don't remember the name, but HDL, right? And so HDL went under. And what the MD of PMC ended up doing in this case, instead of sort of coming out clean and saying that, hey, we're in trouble, they sort of started cooking up the books. So as you are on your journey to design a bank, please don't do that. Do not cook your books. That's terrible because eventually that will come back to you. And but the problem that exists now is that all these existing banks have a lot of bad debt, or a majority of them do. Then you have all these regulations which are attacking banks left and right, such as you saw the UPI one, the interchange one. Now recently we've got bankruptcy regulations, but even they have been untested and don't cover the entire gamut of challenges that could exist. And these are important regulations for recovery of funds for customers, as well as for a bank to operate and exist successfully in a capitalist structure. And of course, as mentioned previously, the banks currently rely on what is effectively called a spray and pay method, which is if they want to lend out funds, they will effectively man call centers and call up every living individual they can 20 times, hoping that one of them is going to bite and take a loan. That is because they don't have the data to predict or understand who would possibly need a loan at what time. And they have this existing infrastructure of call centers and agents and RMs and this and that, which they just can't fire overnight. So you're getting the picture, right? There's all these things that are like sort of burdening the banks, and this has created a terrible situation for them, but an opportunity for you. So basically, now let's talk about how do we solve this, right? Like we have essentially these existing banks which have a purpose to play. You need to give out funds to unlock human capital, especially in India, unlock value, and you need a place where people can safely store the deposits without banks going under. You need to make sure that and current banks are failing because they have a lot of bad debt that they need to clean up before they can even look towards the future. They have a lot of existing overhead that they just can't get rid of. So what is the solution to this? Simple, it's technology. And it's a tech talk after all. So I'm sure I've been talking a lot about non-tech related things, but this is where we intersect, we marry the whole banking aspect with the tech aspect. So there's four basic pillars on which technology can fix this, which is low capex, low opex, uh, amazing customer experience, and effectively a fully digital experience, right? So cut out offline unless you need it, focus on digital, and focus on customer acquisition. So acquisition being waitlist referrals, etc., because that is where the majority of your capex and opex is going. If you are able to have a digital journey, that reduces your overhead and service costs a lot. And you probably can figure out where this is going towards, towards challenger banks and neobanks, but not just towards neobanks, but talking about fintechs in general. The reason fintechs are able to operate better is because they don't have physical presences. They're not, they don't have this traditional infrastructure to rely on. But beyond all of this is stuff you already know. Let's figure out like two very simple frameworks which can actually help you leverage and set up your own bank or fintech or whatever you go for. First is alternate data, right? And this is one of my favorite slides because this just has three logos: a multinational bank, an Indian fintech, and a cupcake. As you can tell, I'm obsessed with cupcakes a little bit, but I'll basically talk about alternate data as being one of the superpowers that you can have as a non-existing bank, as someone, a new financial entity that's coming into the space, and being able to leverage that way better than what any other existing company is doing. So let's start with Citibank. It's a pretty interesting story. So this is an example of a existing financial institution being able to leverage alternate data to better perform. So Citibank wanted to expand its presence in Morocco, and so they went to Marrakesh and they tried to understand how could they better service clients over there, and increase the customer base. And the reason to do that is, of course, to lend funds, and because that's how you make money, as we just learned. So what they did is they went to all these shopkeepers and stores and merchants, and they realized, similar to India, uh, most of these didn't have any formal ways of banking. They didn't usually have bank accounts. They were mostly focused on cash transactions. It was a trust-based system between the merchant and its regular customers. The loans they gave out were sort of all written on pen and paper, similar to India, and there was just no way for a traditional bank to come in and go and safely issue any of these merchants a loan. But Citi was adamant in terms of onboarding these customers and expanding its market presence over there. So instead of the traditional approach, what they did is they partnered with the fintech. And what the fintech was able to do is go to each of these merchants in these local shops. You have these old markets, like a bazaar, effectively, with a lot of different stores and hawkers and vendors and all these people. And they would go from vendor to vendor, take this traditional diary they had, and manually input all this information into the digital ledger so that they could create a bookkeeping record for each vendor to understand what sort of payments they were making, what sort of loans they were giving out to the customers. And using this data, which they went out and collected, an alternate data set, they were able to accurately predict what the credibility of a vendor would be in paying back the loan. So they were able to create their own credit score through this alternate data, and able to expand the business in Morocco. And so this is one way. Basically the point being that you have to get really creative in terms of what the alternate data you need to get, which would give you an advantage over other vendors. OK Credit is doing a similar thing in India. OK Credit is another YC company. If you haven't heard of them, they're similar. They're basically Khata Book and OK Credit. What they do is offer a free ledger to shopkeepers, merchants, and vendors in India to keep track of their transactions, purchases, and mini loans that they give to the customers. And based on that, they're able to predict their credit score and offer loans. So similar model as Citibank has taken. Another favorite story of mine is related to cupcakes, right? So I heard the story from a friend of mine at college who told me that at one of the hedge funds that he interned at. So if you don't, for the uninitiated, a hedge fund is just a fancy way of saying a fund where other people's money, rich people put their money for a professional money manager to make you more money. And yeah, Wall Street's full of hedge funds. So he used to work at one of them, right? And they had found this incredibly creative way of predicting how one of their positions would behave quarter to quarter. So basically, the way you make money in the market, right, as a fund, is possibly you want to predict if the market's going to go, if a certain position is going to go down or up, and of course, you want to sell when it's high and buy when it's low. Basics, right? But it's a lot harder than it sounds because it's a complex thing. But anyway, going back to the cupcake story, what the head of this fund or the portfolio manager would do is pretty genius. He would effectively every day at lunch go to this to the store of this cupcake business, right? It was a publicly listed company, and buy a cupcake. And at the end of the month and at the end of the quarter, he would be able to accurately predict uh, what the position was going to look like. He was able to accurately predict the trend and make a killing out of it. Here was his great insight, right? Every time he would go to the cupcake store and buy a cupcake, he would collect the receipt. Now, the cupcake company's vendor, whoever their vendor was, hadn't actually randomized the serial number of the receipt. So every time he bought a cupcake, he was able to tell exactly how many orders had been placed by that business on that day and extrapolate all this other information out of that and be able to predict, make a killing in the market because of that. So basic idea, look for alternate sources of data. The other thing that you need to focus on, apart from alternate sources of data, because especially in a place like India where a lot of credit related data or financial data may not exist, is focus on distribution. So the clearest example I can give is of non-fintechs that are becoming fintechs. So going back to the first slide, every company is a fintech. Look at WhatsApp, they have payments now. Google has Google Pay now, right? But focusing on the distribution aspect, what WhatsApp, Uber, and Swiggy have been able to achieve is get a collection of a certain specific segment of the population, right? A demographic. So Swiggy and Uber has contract workers who are doing, X amount of work, and they are able to accurately have alternate financial data on these suppliers, right? So Swiggy knows for its delivery people how many deliveries they're completing, how much money they're making, what their capital expenditure is, sort of, and can predict accurately what will be their uh, ability to pay back in the future. So if Swiggy were to offer lending products, they would be one of the best distribution channels because A, they would have all this supply, which is their riders in one place, which is the distribution. And second, they would also combine that with the alternate data we talked about. Same with Uber. Uber has these riders and they know exactly how much a driver is making week to week, month to month, how many rides they're completing, and be able to. And since they already have this pool of existing clientele that they can offer lending products to and the alternate data, it's a killer combination. WhatsApp is a little more generic and this focuses purely on distribution, right? So if you're WhatsApp, everyone's using you, you could just integrate payments and boom, you're a fintech company and a big one too. But what if you're starting from scratch, right? So the entire point of this talk has been to help you design your own bank. And chances are that you may not have started Swiggy or Uber, or you may not have a company with millions of customers. So what do you do if you're starting from scratch? So A, you of course focus on alternate data we talked about, but how do you get customers for this alternate data? Simple answer, have a hook. So if you research or look at majority of the fintechs which exist today and the way they started, they they didn't take something from you, but they gave you some value for free. If you look at Neo, which is a Neo card, or if you look at Revolut or N26, which are these massive neobanks in Europe and UK, what they offered was a free remittance product, right? So what Neo did is give you this travel card with no FX currency charges, no monthly charges. And because they were able to offer you this free product that you wanted, they were able to upsell other products. Like now Neo has fixed deposits with Equitas Bank and is effectively a Neo bank. Same with Revolut and 26 and Monzo. They started with this free product, but eventually they were able to offer entire banking solutions, investing solutions, insurance, and you name it. Because the whole idea of fintech is based on two things, right? One is you need to have an edge in terms of alternate data. And second, you need to figure out distribution. Once you have distribution, you can upsell anything like a bank does, but better. And if you don't have a free product to give or someone's already done that, the next thing one of the other things you could do, which is in fact arguably even better, is be the first one to offer a certain service or offer to a certain segment. So Nubank was the first neobank in Latin America. And what happened in Brazil and other countries in LATAM is the banks were terrible. They were similar to Indian banks. And so Nubank came along and decided to offer a much better experience. And just last year, they IPO'd at $40 billion. And they didn't exist a decade ago. So because they were the first in this specific segment in LATAM, they were able to really scale it up. But segment just doesn't mean geographical segment. It could also mean, income segment. It could mean professional segments. It could refer to anything. Some of the most successful models I've seen are fintechs that are targeting uh, customers on various different planes, right? So you could have a neobank like Chime or a early payment app like Earnin, which is targeting a subprime retail customer in the US. Subprime means someone who doesn't have a good credit score. Then you could have a fintech application like Titan, which is targeting your Henrys. Henrys are high earners who are not rich yet. So someone who has a high income but is not considered uh, wealthy by traditional bank standards. So as long as you can find a segment that you can really hone on, and of course offer all the nice bells and whistles like digital onboarding, my least amount of friction, and ideally combine that with some sort of free hook, right? Like if you're offering some sort of value to them for free without charging it, and you combine that with then some sort of alternate source of data which is able to enable you to do all this, you have a killer product. One of the best examples of this would be a company called Brex. Brex is one of the, I believe, 40 companies in the world which is worth valued at more than $10 billion. It's a startup. It started like 4 or 5 years ago. Another YC company, actually. So as you can tell, I'll only talk about YC companies, got to rep YC. But uh, what Brex did is they realized that when a company was starting up, it was very difficult for the founders of that company to secure credit, because if they went to a bank to get a corporate credit card, they had to often put their personal savings as collateral, or their personal investments, which no one wants to do, right? Like, you don't want to put that on the line. So what Brex was able to figure out is, hey, what if we change the business model, and we know that this startup has no data on whether they're going to succeed or not. Again, this goes back to the data problem. And what they did is they then looked at an alternate source of data. What they essentially did is see that if a startup, for example, had gotten accepted into YC or another accelerator program like Techstars or something, then there was a very high probability of them being able to fundraise further and being able to pay back that, be able to scale. And so that was the sort of alternate data point that they used, and were able to offer very generous credit limits to all the startups in the succeeding YC batches, and in 4 years' time become a $10 billion company. And of course, they've expanded the market size and all. But yeah, that's how they did it. They looked at alternate data, which traditional players like Amex, Wells Fargo, etc., were not willing to consider. And second, they focus on distribution, which over here were accelerator programs, which were a concentration of startups who were their clients. So if you can combine both of these concepts together, you can, build a fintech. And if you can build a fintech, you can build a bank. So if you come back to India, we go back to that same HDFC Pages website. What we are seeing is the similar thing happening in real time. We are seeing digital, better experiences, and most importantly, this hyper segmentation that's happening. So if you go through the pay service that's happening with HDFC, you see Neo and Razorpay are the ones attacking from both fronts. You look at the save feature, you have InstaPay, Neo, Frio, etc. You just broadly look at the personal section. You now have neobanks like Jupiter. Neobanks like Jupiter and Epify. For teenagers, you have a neobank like FamPay. When you look at the credit card advertisement, you have a different credit card for millennials. You have a different credit card for startups. You look at SMEs, you have a different neobank for SMEs. You look at NRIs, that's what we are building over here. So you basically have this unbundling happening. And this goes back to the whole thesis of, find some sort of specialization and be able to offer these products. So before, this all sounds great, but of course we need to look at the biggest piece over here, which is what is the regulation around this, right? And is this something you can do? What's going to happen once you do this? There's a little bit of bad news, which is we are one of the only countries in Asia without a digital banking license. Everyone from Singapore to others have a framework, a legal framework, where a technology company can exist and offer banking or financial services. But today in India, if you want to offer, let's say, a lending product, you need to be categorized as an NBFC at the very least, which is a non-banking financial corporation. Or if you want to be a bank, God save you. But it's not as bleak as it sounds, because I do have a solution, because I've been working on this, and it took us years, and not years, but months and tens of thousands of dollars in figuring this out. But there are two magic words that'll solve your entire problem. It's called business correspondent. And what that effectively means is you will be an agent of the bank. So this is the legal framework in which neobanks today operate. So what you do is you go to a bank, tell them you want to partner with them in a BC model. And this is an RBI framework where a bank can employ third-party agents to solicit customers and act on their behalf as agents. And the whole goal of the BC model is to increase financial inclusion in India. So as long as you're able to make a case that you're increasing financial inclusion in India, these two words will save you. And also, just a note on the future, Niti Aayog recently came out with a working paper about a digital banking license in India. And sooner rather than later, India will eventually get a license. But up until then, it is perfectly legal for you to act as a neobank or a bank of the future by falling under the BC model. So finally, now that we have covered everything from the purpose of a bank to business model to why they're failing in India to how to succeed if you were a bank, which is look at alternate sources of data and distribution. Let's design our own bank, right? So let's go through the ingredients first. If you're watching this, chances are that you probably have shown up for an Exun event and may have some sort of skill, right? I would suggest team up with a couple of your friends so that you have a couple of skills around alongside you. So hopefully, if you have someone, you should have a team which should be able to build a mobile application, ideally design that application, and go get customers. Once you have that, the next thing you need is a target customer segment. Try to figure out who can you target, which is not being done before. And I will tell you right now in India, the opportunities are endless. If you look at the US, there are neobanks for freelancers, there are neobanks for minorities, there are neobanks for practically every segment of their population, sliced and diced along both lanes, and they're all succeeding. And in India, we're just scratching the surface, right? So if you can figure out a segment that you can cater better than an existing bank, and chances are, I definitely think you would, because banks are terrible at catering to everyone because they're doing too many things at once. You've got a killer combination, and with that, a working mobile application, right? So build out an app, an experience. That's the easy part. You can easily get that done. So get a team in place, find out who your customer is going to be, and build a basic product. And I promise you, after the next slide, if you wanted, you could launch your own bank. So, how does this happen? Here's the recipe, right? And this is the Easter egg that I was talking about. First, go to Razorpay. This is a formality, but you need a bank account, you need to incorporate a company, and you need a way to manage payroll and expenses. Razorpay has all of this, under one shop. So you can go to Razorpay Rise, and they will take care of all this legal stuff that you require. Second, and the main, go to an API infrastructure provider such as Decentral and Setu. They today have APIs live where you can offer investment products, banking products, or full-scale bank accounts, checking accounts, and all you need to do is plug and play. Step three, I don't know. Step four, profit, right? But basically, to summarize this, if you have a team, if you have an idea, it's as simple as incorporating, getting in touch with these infrastructure layers that are coming up, who will then facilitate your connection with the bank. And I can promise you, in 2 to 3 months, you would have designed your own bank. Parting thoughts. First of all, congrats. You can design your own bank now. Uh, there's a meta learning part to this presentation that I hope came across. So as you look back into this entire presentation, think about which part you liked the most. Was it the origin aspect? Was it the business model aspect? Was it how to build the bank itself, or was it something else? And based on that, you could probably get some insight onto what you want to do in the future, right? So if it was the origin part, maybe you're more interested in history. If it was the policy part, maybe it's policy. If it was the business model part, maybe it's something else, right? So didn't want to focus too much on this, but if there's a particular part that really spoke to you, I hope that can be useful for you to understand something better about yourself. And finally, if you do end up pursuing and designing your own bank, actually reach out to me. I will get you set up with all the legal contracts you need, whether for agreements with the bank, and I will be happy to connect you with Decentro or any other company and get you up and running. So yeah, that's the presentation. Hopefully you have learned how to design your bank and learned something new that you didn't know before you came into this talk. Thanks.
We'll be taking up some questions.
Awesome. How to build trust among the customers. Uh, yeah, that's a great question. So there are a couple of ways you can do that, right? So going back to the trust point, effectively in the early stage, it's very difficult to build trust among customers, but there are a couple of ways you can mitigate that. A, if you partner with an existing bank, you can basically leverage the trust customers have on that existing entity and leapfrog off of that, right? So let's say you go and partner with a bank like Federal or ICICI, then you're effectively a technology partner for the bank, but in a way, it's your customer, and so you'll be able to build off trust across those brand names that you can leverage. And second, if you actually go do this, if you can actually go build a bank, you can go raise some venture money and put those logos in your website, go do a mini press release, because chances are if you're launching a bank, you've found a unique customer segment to do it, and those are initial ways you can build trust. But the simplest answer is every entity or every company starts as a very small unit which has a set of very strong early supporters. So you really got to find those early supporters, and through word of mouth is how trust would spread, because that's how trust spreads anyway. All right, next question would be, why even build a bank in the first place? Layer 2 for centralized finance, effectively do remittance for free, which you can't compete with unless you make money some other way. Yeah, that's a totally fair analysis. It's just out of curiosity. If you want to build a bank, this is how you do it. Uh, and yep, UPI is able to effectively destroy the entire uh, you know tax on payments. And today, because of, if you combine UPI with a wallet, for example, you combine a card with a wallet, you can even effectively replace a bank account. But then again, that goes back to even what the previous question is about, which is, uh, would a customer trust a non-banking account, right? And there are hints that yes, this could happen in the future. So I do agree that you may not even need to build a bank in the first place. But if you did, this is how you do it. All right, next question. Why is there more competition between the development of online banks and fintechs? Why? Don't quite understand the question. Is it referring to why is there more competition between neobanks and fintechs as opposed to fintech as a category in banks? If it's the former, that might be because, most probably because we're still in the first innings, right? We're in early days. So most of these fintechs, online banks, and everyone else is going after that same segment of customers, which is an early adopter, which probably looks very similar. And the basic uh, solutions that you can offer, or the basic products you can offer, would look somewhat similar in the initial stages in some sense, right? Like it's either an investment product or a savings product or a lending product. So inadvertently, fintechs will be competing against each other in these subcategories. And so that is perhaps, and because they're digital first in the audience, and you and I are more digitally native than perhaps the other segments of society, it may be a perception that there's more competition between fintechs as opposed to banks and fintechs. I hope that was the question and I was able to answer it. Uh, Next question is, what are some unconventional segments that Indian neobanks can target that aren't already targeted by fintechs or brick and mortar banks? Hmm. Great question. If I was able to answer that, then I guess that would leave no work for you. So you would have to think about it. But jokes aside, I think there are clues that you can look at, right? So one of the easiest ways to understand this is, A, look at what's happening in the rest of the world, because that can give you a good idea about what are segments where they may be demand. So if you look at the US, for example, they had a neobank for teenagers, which then FamPay came along and was able to emulate and replicate in India. In some senses, it's not a neobank. It is eventually going to be a neobank. It's a wallet with a card product right now, but they've been extremely successful because they've been able to focus on this segment. I don't think there's a neobank for freelancers in India. There could be a business over there. there are a lot of these segments. Like there are a couple of other neobanks targeting Henrys and HNIs that have started in the US, and the verdict is still out whether they'll succeed or not. So it's left to be seen. But India is actually more interesting in some ways because you can have more unconventional segmentation, and so it's really upon you to research a bit and figure out where there could be an innovative space to offer that. But sorry, no ideas off the top of my head. Do reach out if you come up with any, and we can brainstorm a bit more. Next question would be how to compete against big banks at the initial stages. Yeah, that's pretty easy. Banks have a lot of uh, how do I say it? Public negative public debt. Like the perception is terrible. Like if you think about an Indian bank, you think about long queues and offline processes and terrible mobile app and everything. So just focus on their weaknesses and project those as strengths. So effectively, if you're able to leverage their trust by saying, hey, we're partnering with a bank, but also at the same time, market those specific pain points that customers face, which is waiting in line or having to get on a call to solve a problem or having to wait for days for something to get resolved or having a terrible mobile application or a non-digital onboarding experience or segment specific pain points. Then that's how you compete against big banks, and in fact that's how you beat big banks. So if you take the new bank example, they're much larger than most of these LATAM banks now. If you look at the US, Chime, which is one of my favorite examples to go back to, didn't exist 5 6 years ago, and today has 15 million customers that it's stolen from Chase, Bank of America, Wells Fargo, banks that have existed for centuries, and is going to IPO $25 billion. And it's in its first like 5 or 6 years of existence. Imagine where it's going to be in the next few decades. So actually, I would say it's much easier to compete against big banks than other, faster fintechs. Like the strength you have is you can operate a lot faster. You're a lot leaner of a team. Your OPEX, CAPEX is lower. And so, you can really benefit from all those variables. That was all I had. So
Thank you, Prateek, for such an amazing talk. I guess I'm ready to.
I think we have one last question.
Do we?
Just popped up. Yeah.
Yeah, we'll just wait for that.
Do you see neobanks as replacements of brick and mortar banks or as supplements? Recently, Niti Aayog also presented an idea to replace physical branches, so that doesn't seem too feasible in the future. That's a good question. I think here's why here's why I think it's a really good question, and why there's no straightforward answer. Because if you look at you can segment India into separate sets of population. This is a framework that I've read online, so it's not my idea, but essentially you have what's called Bharat, and then you have what's called India, and then you have what's called India 1, and a subset of that is India Alpha 1. So India 1 would be sort of your affluent, urban tier 1 city population. India would refer to, tier 2, tier 3 cities, towns, etc. And Bharat is sort of majority of rural areas. And I may be fudging it up, but this is the core concept. And India Alpha 1 is like your top 0.1%, or an easy way to understand is CRED's customers. So the reason why I think physical branches would exist is in Bharat, and often even in India, you would need that, right? So there is a segment of India Alpha 1 and India 1 where I think there would be a lot of value in terms of replacing brick and mortar branches for a segment of population. But, and especially because we're a young country and very mobile savvy, it seems feasible. But there would still be HNIs and others who would require some sort of, in-person interaction, because when you're dealing with high net worth clients, there is some sort of interaction required. So my idea, what I think is the answer wouldn't be too drastic, but it would be some sort of middle ground where there would be certain banks and certain branches that exist, perhaps priority banking or so, and and branches would continue to exist. Maybe or maybe not. The verdict is out there for India and Bharat, and I would hope that they don't. And fintechs are able to capture that market. There are a bunch of micro lending startups that have tried. There are a lot of others that have tried, but it seems that we haven't really cracked that equation yet. So I hope someone is able to. But until that happens, I don't think that we would have the feasibility of replacing all brick and mortar branches. Okay, so we have more questions now. How will making of a bank profit us? Plus, how can we be sure that the ratio of interest in FDs and loans is equal or in a profit position? Yeah, great questions. How will the making of a bank profit you? It may or may not, right? Like, I find it intellectually interesting and pretty fascinating. So I was like, I should do it. But yeah, but to answer your question, there are a couple of ways it could, right? A, you could focus on a segment which is being underserviced, and so it could profit you because you'd be able to get customers who are currently dissatisfied with their level of service and come to you, and you could not only monetize from offering services, but as another bank does by offering ancillary services. So effectively, where banks fail, traditional banks, is they try to cater to every segment of population, and they try to sell almost everything to everyone. What the future looks like is essentially this hyper segmentation, or this sort of like you know banks that are going vertical, so focusing on a very specific segment and then cross selling and upselling products specifically to them, which are better tailored to them. And that's it's a really good question on how can you make sure the ratio of interest in FDs and loans is equal or in a profit position. So if you're setting up a bank in India, for example, you would uh, be offering an existing bank's FD if you're a neobank, and so there would be a certain interest that they're providing you. And as long as if you do get an NBFC license or are able to lend, as long as that interest is higher at which you're lending after your OPEX and CAPEX, you should be good. The way it would initially exist in day one of you starting this is you'd probably just offer a deposit product or a lending product. If you're just offering a lending product, like in a micro lending startup or something else, then you would be getting capital from an external source. Maybe it's an NBFC, maybe it's a bank which is securing your credit line, and there would be a cost of capital associated with it. So you would be getting that at an expectation that maybe it's 4%. And the way you would get that is you probably have some financial model or some idea that you could target this customer at a percentage which is higher than that percent. And so there's that delta or the spread which will effectively take care of it. And if you're starting from the other side as a deposit, then you'll purely be focused on accepting deposits initially. And then eventually, once you have an idea of what your capital expenditure is, what was the cost of servicing a customer, uh, you'll be able to also offer lending products. And yeah, you can make sure that uh, the the spread, I think, that which you were referring to is airtight. And uh, and otherwise, yeah, I mean, like, you basically don't even need to have complex mathematical models. You can Banks are already profitable. Just extrapolate. Like, banks are making money with high capex, high opex, like physical branches, etc., and offering loans at a certain percentage. So what you can do is, if you hypothetically, if you're doing a thought experiment, had the same capital that a bank had, no branches, none of these people, and you were giving out a loan, you could arguably even give it at a lower interest rate and still make money because that margin from those expenses are being saved. So as long as you can calculate that, extrapolate that, and usually the vendor will just tell you you're good to go. Next question is, how can you see neobanks founded in India get established internationally? Hmm, that's a really good question. That's, I think, what I'm trying to do as well. So we're building a neobank. We're building investment in neobanking products in India, but we're building initially for Indian expats because our goal is not to just be a bank or an investment app or a finance app, but our main mission is to increase the amount of investments coming into India. The whole goal is to increase FDI in India. And the way we think we can do that is by first targeting Indian expats like NRIs, PIO, OCI card holders, etc., and getting their investments deposited in India. So that's one of the ways I see them getting established internationally. Hopefully, if what I'm doing succeeds, that'll be one example. But Other ways, I think, can be, it depends on whether you want to establish internationally, right? Like if you look at India, it's one of the largest markets in the world. There's a reason why American companies want to come to India, because you have the next billion users here. So I would almost argue that you don't even need to get established internationally. Just the domestic market is large enough and wealthy enough that this is where you begin and you end. So there's a lot of options. There's a lot of potential in India, and that's the reason I shifted back, right? So just giving another like random uh, piece of insight into me. I was living in SF up until last year, and I willingly shifted back because I think India has all the opportunities, and it's a much more exciting space to be in. So yep, I think so. There are ways you can get established internationally, but if you're able to scale in India, you will be internationally known, and that doesn't even matter because you'll succeed as a business and a company in India. That should be all the questions, I think.
Thank you, Prateek, for such an amazing talk. I guess I'm ready to launch my bank now. I found it very interesting, and I hope our audience did too. Thanks for joining in, and I hope you all enjoy this session. See you at the next Exun Talk.
Thanks so much for having me. All right.